When planning for recession, most people would ask a question, what should I invest in during recession? But an equally important or maybe even more important question to ask is, what should I not invest in order to protect my portfolio during the recession? Conventional finance theories would define risk as volatility or the price fluctuation of stocks. But the greatest investor of all time, Warren Buffett, defines risk as the permanent loss of capital.
Risk with us relates to several possibilities. One is the risk of permanent capital loss, and then the other risk is that just an inadequate return on the kind of capital we put in. It does not relate to volatility at all.
During times of recession, you cannot completely avoid a temporary decline in the value of your portfolio. But what you must target for is to avoid the permanent loss of your invested capital. So in this video, I will tell you what are the investments that you must avoid in order to not permanently lose the money that you have invested. My name is Kanak and welcome back to my channel. Subscribe to my channel for interesting content from the world of finance, economics and investing. The first type of stocks that you must avoid during times of looming recession are stocks of companies that are highly leveraged. Or to put it simply, companies that have massive debt on their balance sheet. And the reason you must avoid these stocks is because during times of recession, the overall demand in the economy declines, and it causes a corresponding decline in the revenues of the companies that have a very low chance of survival during the times of recession. One good indicator to measure debt is debt to equity ratio. This ratio measures companies' liabilities with its shareholder equity. Shareholders' equity is nothing but the net worth of the company. Coming to the second type of stocks that you must avoid are consumer discretionary stocks. During times of recession, the unemployment in the economy increases and the spending power of people reduces drastically. And this causes people to spend less on discretionary items such as travel, hotels, cars, fashionable clothing, and so on. And as consumer spending declines for discretionary products, these companies observe a corresponding decline in their revenues, which eventually translates in a decline in their stock prices. Moving on to the third type of investment that you must avoid during times of looming recession is high-yield, non-investment grade bonds of private companies. Recession particularly hits hard on companies with poor credit rating and also companies that are smaller in size who have hard time competing with the big players. And if you invest in the bonds of such companies, then you are exposing your portfolio to the default risk of these poor credit rating companies. The fourth type of investment that you must avoid are speculative stocks and options. If you are an option trader or speculator in penny stocks, then recession can wipe out your money in a very short span of time. Although the pre-recession boom can make you believe that you can make money from penny stocks or by trading options, the sudden collapse in the stock market can wipe out all the gains that you made. Although these were some of the investments that you must avoid in order to protect your portfolio from recession, it is not advisable to completely pull your money out from the investments because it is nearly impossible for an individual to predict when and how deep the recession will be. So the best investment strategy during the times of recession is to dollar cost average in high quality businesses for long term.